Section 1. A New Dawn for Student Debt. Understanding Trump's Big Beautiful Bill. On July 3, 2025, President Donald Trump's nearly 900-page mega-spending bill passed Congress, awaiting only his signature to become law. This sweeping legislation makes the 2017 tax cuts permanent, adds new business benefits, and rolls back clean energy tax credits. But hidden within its pages are monumental changes to the federal student loan system, ushering in a new era for how Americans pay for college. The bill doesn't just tweak the system, it overhauls it. Decades of complex repayment plans and forgiveness programs are swept away, replaced by a dramatically simplified yet riskier system. The changes primarily affect new borrowers, so high school students and their families must pay close attention. The government's philosophy is shifting away from income-driven safety nets toward a more direct and arguably harsher repayment model. This big, beautiful bill is about more than budgets. It redefines the relationship between students, the government, and the cost of a degree. For the 40 million Americans with existing student debt, the immediate impact is minimal. The bill targets future loans, not current ones. Still, the ripple effects will be felt everywhere, as borrowing caps and the elimination of programs force a national rethink on college affordability. The value of a degree versus the debt required to obtain it is now front and center. This is the new reality for students, parents, and educators, starting July 4, 2025. Understanding these changes is essential for anyone planning to attend university in the coming years. Section 2. The Old Guard Falls. Saying goodbye to familiar repayment plans. For years, borrowers navigated a maze of repayment options: payee, repay, IBR, ICR, and more. These income-driven plans offered flexibility, adjusting payments to income and family size. Alongside them were fixed plans like standard, graduated, and extended, each with its own rules and timelines. The new bill eliminates all existing income-driven repayment plans for new borrowers. No more payee, repay, IBR, or even Biden's Save plan. Supporters argue this will simplify the system, reducing confusion and administrative burden. But the elimination of these safety nets marks a major philosophical shift. The new system moves away from payments tied to what borrowers can afford toward a more rigid, less forgiving structure. Flexibility is out, predictability and risk is in. Instead of a menu of options, new borrowers will face just two distinct pathways. The long-term cost of borrowing will become more fixed, and for many, potentially much higher. This change fundamentally alters the financial calculus for students considering college. The era of multiple safety nets is over. Now there's only one alternative to a fixed payment schedule, and it's less generous than before. Section 3. The two new paths. Standard repayment versus the repayment assistance plan. The new law replaces the confusing array of repayment plans with just two options. First, a modified standard repayment plan, fixed monthly payments over 10 to 25 years, based solely on your loan balance, not your income. No matter your salary, your payment stays the same. It's predictable, but offers no relief if you hit hard times. Second, the repayment assistance plan, an income-based option, but less generous than previous plans. Payments are set between 1% and 10% of discretionary income, but the exact percentage is uncertain and could change. For example, a graduate with £30,000 in loans would pay a fixed amount under standard repayment, or a variable amount under the new assistance plan, likely higher than under Save. The repayment assistance plan is expected to result in higher monthly payments for many, especially those just starting their careers. Choosing between these two plans will be a crucial financial decision for new graduates. Standard repayment offers certainty and a clear end date. The repayment assistance plan links payments to income, but with more uncertainty and potentially longer repayment terms. The era of multiple safety nets is over. Now, there's only one less certain alternative to a fixed payment schedule. New borrowers must weigh their career prospects, income potential, and risk tolerance carefully. The financial stakes of this choice are higher than ever. The system is simpler, but also less forgiving. The safety net is thinner, and the risks are greater. Section 4. The End of an Era. What happens to borrowers on the Save plan? About 8 million borrowers are currently on the Save plan, which will be phased out under the new law. These borrowers have a transition period. Between July 2026 and June 2028, they must choose one of the two new repayment plans. Until then, they can continue under Save, but the clock is ticking. If they don't choose by July 1st, 2028, they'll be automatically enrolled in the Repayment Assistance Plan, whether it's the best fit or not. The SAVE program's legality is also being challenged in court, adding more uncertainty. Regardless of the court's decision, the new law provides a clear path forward. For SAVE borrowers, change is coming fast. Many will see their monthly payments rise, sometimes dramatically, when they switch to the new plans. Families should prepare for this payment shock and start budgeting now. The forced migration from SAVE will be a major financial event for millions. Planning ahead is essential to avoid surprises. One of the most significant changes in the new bill is the introduction of strict lifetime borrowing caps for federal student loans. Previously, students, especially graduate students, had more flexibility in how much they could borrow over time. Now, there are hard caps: £100,000 for most graduate degrees, £200,000 for medicine and law, and £65,000 for Parent Plus loans. These limits are designed to curb excessive borrowing and shift more responsibility to students and universities. For many, these caps won't cover the full cost of attendance at expensive private institutions. Parents, who could once borrow up to the full cost of attendance, now face a strict lifetime limit. The era of unlimited federal borrowing is over. Students and families must plan their entire educational journey within these new boundaries. This will require more careful long-term financial planning. Many may turn to private loans, which often come with higher interest rates and fewer protections. The new lifetime borrowing caps will reshape advanced education in the U.S. Many master's and doctoral programs at private universities exceed the £100,000 cap, forcing students to seek stipends, assistantships, or private loans. Medical and law students face a £200,000 cap, but costs can be much higher, leaving funding gaps. Students may have to choose less expensive public universities or risk taking on costly private debt. This could create a two-tiered system. Those with family wealth can still access elite schools, while others are priced out. The dream of attending a top-ranked professional school may depend more on personal finances than ever before. Prospective graduate students must now rigorously weigh the cost versus the potential earnings of their chosen field. Strategic, pragmatic planning is essential from undergraduate through postgraduate studies. The financial stakes of pursuing higher education have never been higher. The new rules demand a new level of caution and foresight. The new law brings sharp changes for parents and part-time students. The £65,000 cap on Parent Plus loans means families can no longer rely on unlimited federal borrowing to cover college costs. This shifts more financial burden onto students, who may need to seek private loans or choose less expensive schools. Families must have tough conversations about affordability much earlier in the process. Part-time students also face tighter lending limits, making it harder for working adults and non-traditional students to access federal aid. Reduced access to deferment and forbearance means fewer options during financial hardship. The new system is more rigid, with less room for error. Borrowers who lose jobs or face emergencies will have fewer ways to avoid default. The government is reducing its risk, while increasing short-term pressure on borrowers. The financial landscape for higher education is fundamentally changed. With these sweeping changes, students and families must rethink how they plan for college. Start planning earlier. Don't wait until senior year to consider costs. Use the new borrowing caps as hard boundaries in your financial planning. Expand your university search to include affordable public and in-state schools. Treat your undergraduate education as the foundation for your future. Don't use up all your borrowing power at once. Hunt for scholarships and grants relentlessly. Every pound you don't borrow is a pound you don't repay. Apply for aid early and fill out the FAFSA as soon as possible. Have honest family conversations about what's truly affordable. Use online calculators to estimate future monthly payments under the new plans. Understand the total cost of a loan, not just what you borrow, but what you'll repay over time. Financial literacy and proactive planning are more important than ever. The new era of student loans demands a new approach. Preparation is the key to success. The student loan system is undergoing its biggest transformation in a generation. The Big Beautiful Bill simplifies repayment plans and sets clear borrowing caps, but at the cost of flexibility and generosity. Safety nets like income-driven plans and payment pauses are being scaled back. The risk is shifting from the government to students and families. New borrowers face a stark choice: fixed payments or a less generous income-based plan. Lifetime borrowing limits will force a nationwide rethink of what's affordable. More students will turn to public schools or private loans to fill funding gaps. For current borrowers, especially those on Save, a period of transition and tough decisions lies ahead. The world of student loans has changed overnight. Success now depends on planning, transparency, and financial realism. The future of higher education funding is different, and preparation is everything.